I've been following Groupon for the last 4 months or so, ever since the first S1 came out. And as you may all know, they're scheduled to go public next week on November 4th. They are starting off their Groupon Roadshow this week. For those of you who don't know what that is, they're going out and talking to institutional investors and talking about the merits of the company and why people should invest in Groupon. And they're looking to raise about $500 million at a valuation of roughly $10 billion. So we're going to start today. We're going to watch the Groupon Roadshow live in its entirety. And while we're doing that, feel free to ask questions using text in the chat window. And I'll be providing commentary there as well. And after the video has finished playing, then there'll be an open Q&A and some further discussion. So I'm going to go ahead and start the video right now. Well, we're waiting for questions. Some of the things that came to mind as I was watching the roadshow is, one, they keep pitching it as a win-win-win for everybody who's involved. And really what we're looking at when we're talking about Groupon is a zero-sum game. You've got a pile of money that can be split among consumers, merchants, and Groupon. And the way it has played out so far is that consumers have gotten a great deal. They're getting things at half off in many cases. Merchants have not gotten a great deal. They get typically 25% of what their normal pricing would be, and then Groupon on each transaction actually gets a pretty good deal because they get the other 25% for not a whole lot of effort and work. The merchant's doing all the work, they're servicing all the customers, and Groupon's providing a marketing service. So right now the winners primarily are consumers and Groupon. Over time, I see that changing. A lot of merchants are getting savvier about Groupons, and they're structuring them in ways that the Groupon can potentially work for them. They're putting a lot of conditions on it. Hotels, especially, will only let you use your Groupon deals when they would otherwise be empty and get no money. There were times I bought a Groupon myself for a hotel in Santa Monica. I called them up, tried to make a reservation. They said, yeah, sure, we can take your reservation. I said, I have a Groupon. They said, oh, sorry, we don't have any rooms available for you, because Groupons go into a different inventory bucket. So as merchants get savvier, you're going to have consumers have more trouble than they had in the past in redeeming these deals. It comes down to fundamental economics. Either merchants have to raise prices to cover the cost of the discount, or they give lower discounts and issue fake pricing, much like businesses have done all along. If you look at department stores, furniture stores, a lot of their quote-unquote retail pricing is fake. It's inflated by 50% so that they can run a sale eventually and lower their pricing and give consumers a perception of a discount. The great thing about Groupon from the beginning was that you only had to make a decision on whether you wanted to buy the product or not, whether it was something that appealed to you. It was always a given that a Groupon was a discount, and increasingly it's not a given. I've actually seen deals where the Groupon price is higher than the regular price. So if consumers have to go through that extra step of thinking about it, they're going to be less likely to buy Groupons. And then the other thing that came up from the overall discussion was just the attempt to pitch Groupon as a technology company. And by every metric I can look at, it's really not a technology company. As I pointed out in the text chat, only about 5% of the employee base at Groupon is in the technology function. If you look at the overall split of people within Groupon, about 80% of them are in roles that will need to scale as revenues scale. So if you talk about editorial, city planning, sales, merchant services, consumer services, those are all roles that will have to increase as they grow revenue. So about 80% of their staffing will have to keep scaling with the revenue. Any questions? Feel free to type them in, and I'm happy to take them. Hold on just a second. Apparently my screen is not showing the questions that are out there, so I'm going to try to get the questions from over Skype. Hold on just a second. Okay, I now see questions. Okay. Okay, one of the questions was why do the quarter-over-quarter numbers matter so much versus year-over-year numbers? Partly just because of the changes in the big concern investors would have is whether the company is going to continue to grow. That's what they're putting their money in for. If you look at the sequential numbers, I believe in Q2, revenue grew about 22%. In Q3, revenue grew about 9%. So we're seeing a steady decline in revenue growth for Groupon with the decline in marketing spend. If they continue to hold off on marketing in the fourth quarter, that may be a quarter where we actually see a decline in the actual revenue that they get and a decline in Groupon sales. We've already started to see declines in some of their more established markets like Boston, Chicago, and Berlin, and that's a very worrying trend for somebody who would be investing in this company, that they're investing after the company's already reached its peak, and they're expecting it to continue growth, and the sequential numbers on the quarterly don't seem to indicate that that will continue unless they invest a lot of money in marketing. In terms of the actual level of debt, again, that goes back to how you define debt. According to the metrics that they're using, their debt is zero. The number that I pay most attention to is how much they pay out to merchants or how much they owe to merchants. Right now, they owe about $465 million to merchants. That was about 390 in the previous quarter, so it's grown about 20% quarter over quarter. Part of it is a function of how they handle cash flow. They typically get paid by credit card companies immediately after Groupon runs. In the United States, they pay the merchant in installments over a period of 60 days. In other parts of the world, they pay merchants only when the Groupon is redeemed. So they get to hold on to that cash until the Groupon is redeemed, or for 60 days in the United States. That's great for Groupon from a cash flow perspective. It's a big risk for merchants if something were to happen to Groupon. I did a piece yesterday for VentureBeat on who would get hurt if Groupon happens to go under, and there are a lot of parties that would get hurt, including consumers, merchants, credit card companies, investors, of course. Feel free to look that up. Lots of great content in there. Okay, what does Groupon's Roadshow mean for me to competitors like Living Social and Amazon? That's a good question. In terms of Living Social, it seems like they have decided to put off their own roadshow. Living Social has always been a small competitor compared with Groupon. In the last quarter, their gross billings were about $45 or $50 million, and $10 million of that was the Whole Foods deal, which I believe was done at a subsidy. So, that accounted for about 20% of their revenues or their gross billings in the third quarter, which is pretty scary that one essentially money-losing deal was that big a part of their gross billings. I think if I were Living Social, I agree with their decision to seek private funding, so they're not in the spotlight as much as Groupon has. I think their best play right now is to, get closer in with Amazon, see if potentially there's an acquisition opportunity with Amazon, and try to figure out a real business model that works long term. Okay, the massive founders round have on investor sentiment. One of the things that I pointed out is that with this IPO, Groupon will be raising about half as much money as they've raised in previous rounds of financing, but the company itself will get 4 times as much. In previous financing, they've raised close to $1 billion, and about $800 million of that, actually more than $800 million of that, has gone to cash out early investors. And I went back and did the math on this. If you took the Amazon IPO, the entire market cap of Amazon at the time that they went public, you adjusted that for inflation, that is still less than the amount of money Groupon investors have taken off the table, which is pretty impressive. Groupon's co-founder, executive chairman Eric Lefkowski, and his affiliates have taken off the table more than $300 million. So it's, it's a big question mark for investors that why should they invest when big insiders have taken so much money off the table. Okay. Let's see here. Any existing investors reinvesting in the company? I don't know the answer to that. Anything about Groupon's targeting technology? I don't know the answer to that either, other than it doesn't seem to be working very well if I'm getting the kinds of deals that I'm getting. The thing about emailing somebody on an everyday basis is that if you keep emailing them things that they're not interested in, they're going to stop opening those emails. And that's what's happened with a lot of people that I know. It would have happened with me if I didn't actually work in the space and want to track what was going on. There's just too many other things to do with my time than look at deals from mani-pedis and other services that I have no interest in. Email open rates go down. How can Groupon change this? That's one of the things that I've been calling on Groupon to do for a long, long time, and they haven't done it yet. Doesn't look like that they will, is talk about their email open rates. That's a material number in my mind that, because it's primarily an email-driven company, most of the revenues come from that. Investors ought to know what the trend line is on their email opens, and, I would suspect if it's like most other email products, people stop opening emails, and investors really need to know what's going on. And that's information Groupon must have internally. If they're not tracking email open rates, then you shouldn't be investing in Groupon just out of sheer stupidity on the part of management. But clearly they have that information. They should be sharing it. Okay, do I ever think there will be a sustainable business model in the daily deals marketplace? I think deals will be around forever. Deals have been around forever. Groupon just, combined that with a massive mailing list and a telesales operation. Deals will continue to exist. They won't exist at the level that we've become accustomed to over the last year and a half. Most businesses don't have the margins to offer 50% off and then give half of that to a third party for advertising. It just, it can't be done unless you inflate prices to account for that so that you can cover your cost and then, hopefully make a profit. One of the big selling points for Groupon when they've gone into small businesses is they say that, it's okay, you're going to, probably break even or lose a little bit of money on the initial deal, but you'll make up for it when consumers come back and they pay full price. Part of the problem with that logic is that even on the initial deal, a substantial portion of the customers will be your existing customer base, especially if you're a high-frequency business like a restaurant or a bar. If you just think logically about it, you're going to be more likely to buy a Groupon from a place you know than a place you've never heard of. And the feedback I've gotten from merchants in the restaurant category is typically anywhere from 50 to 60% of the people who come in are people who would have come in anyway. So you're taking a 75% hit to revenue to acquire somebody who would have likely come in the door anyway. The other thing I'm hearing more and more of is people who say they don't go back to places that they normally frequent because of the Groupon rush. There is a massive crush of people who come in the first weeks and the final weeks of Groupon, and the regulars just look at that and say, you know what, I don't want to deal with that. So you've turned away full-price customers to get a highly discounted customer who may or may not be coming back. Okay, lifetime value of the customer, ROI on cohorts. Again, that information is new. It was not presented in the S1, which is the officially vetted document by the SEC. That information, some of it just seems to me inconsistent with the S1. I don't know how you would potentially get sequential declines in markets like Chicago and Boston and Berlin if you were seeing, everybody who comes in continue to buy on a regular basis. It doesn't make sense to me. I don't understand how you would get 46% of consumers who would have never purchased another Groupon if people keep buying and buying and buying, as they show in that presentation. And I also don't understand how the average number of Groupons purchased would be 4 if people keep buying quarter over quarter over quarter when you've got a history that goes beyond that. So maybe there's something I'm missing there, but the numbers don't add up. It's, when I look at that, I say maybe they picked a cohort that is not representative. That's a possibility, but mathematically it can't work out that every cohort's like that and the numbers in the S1 are correct. Okay, they cracked the code of web to store. The concept is evolving. I don't know that it's fair to say that they've cracked the code. They have proven that if you give really deep discounts on something, people will buy it. But will they buy it at full price? There was some talk when HP cleared out their touchpads, that the $500 touchpads they cleared out for $150. I ran out and bought one. I have one. I wouldn't have paid full price for it. Does that prove that, a HP touchpad is a great idea, that they should bring it back? No, it proves that if you give something away, people will buy it. And I think that's what Groupon has proven. If you give people really good deals that are not sustainable, people will buy them. And there are days when I can look back at my credit card statements where before I had understood the economics of Groupon for small businesses, there was 1 month where I bought 6 Groupons. And, why wouldn't I? They were great deals. But once I looked into it and once I realized that it just didn't make sense for the small business, I stopped buying them. There's communities like San Francisco, Portland, LA, where there's a strong buy local movement. People want to support their small businesses. I think a lot of people believe that they're helping small businesses when they buy Groupons, and in reality, I don't think they are. They're actually taking a lot of the revenue from small businesses and shipping it off to Chicago or DC, depending on who you're talking about, whether it's Groupon or Living Social. Yes, I did. I pointed out, and I think it's really interesting that in their main competitor slide, they didn't put down Living Social. That just was really odd. Maybe on the bigger slide, they did have Living Social. I didn't see it. That was microscopic. Okay. My company analysis aside, do you believe the stock will pop over the course of the first few weeks? I've actually been trying to get a hold of my broker to get in on the Groupon IPO. I know that might surprise some people, but I'm seriously considering buying the stock because they are floating so little of the stock that I would expect a pop. I would expect that the thing about pops is they can be engineered. You can always lower your final price so that you get a pop once you see what the demand is. So you price at the low end of the range or you price below the range and you can engineer a pop. So one of the things that just because Groupon pops on the first day or the first couple of weeks, it really doesn't matter. It's not a reflection on anything other than the fact that they have a small float. The Wall Street Journal did an analysis. They found that of offerings of $100 million or more since 1998, I believe, only 3 of them had a float as small as Groupon's, and the other 1,900 had much larger floats. So Groupon, much as they have done all along, seems to be engineering the optimal numbers to present the case that they want to present to people. Okay, how does SEC verify the claims in the Groupon Roadshow, and if the claims are inaccurate, what will the SEC do? I think the numbers that Groupon presented for Ceviche are probably accurate, whether they are in terms of the business model behind Groupon, in terms of how successful it was for Ceviche. That's something that to a large extent is unverifiable. Small businesses, for the most part, don't do a great job of tracking things like revenues, things like acquisition costs and so forth. They're just not accustomed to doing those sorts of things. I'm a little concerned that Ceviche refused to talk to me at all, which in my mind is also raises some questions about the judgment of management. If I were in making the most important presentation of my life, trying to raise money for my company, I would ensure that the business that I was referring would be somebody who would say positive things about me, that when the reporters call and the analysts call, as some of them likely would do, I would want somebody who would sing my praises. And I'm sure there are Groupon businesses out there who would sing their praises. I've talked to a few of them. I don't know why they wouldn't pick one of those versus a business who tells reporters, we're not really interested in talking about this experience. Okay, one of the biggest issues with Groupon now is that I have to prepay for a deal instead of just downloading a free coupon with Scout Mob or another mobile service. Isn't that a big reason why it does not take off? I think that's part of the reason. I think there are a couple related reasons that go to that question. One is, for some of these deals, it's just not a deal. I think I pointed out during the text chat that I found a Groupon deal at a local place, Indian restaurant near me, that was $10. Supposedly it was 29% off. And I was a little suspicious because I know that restaurant. I know that it's kind of a dive place, and $13 seemed like a high price for that restaurant for a buffet. And sure enough, it was a high price. Not only was the $13 too high, the $10 that Groupon was charging was too high. The regular price is $8. So one, there's some suspicion about the quality of the deals. Two, in many cases, the savings is $4 or $5. Do you really want to go through the hassle of going through a process of purchasing something and then having to do a dual payment thing to save $4 or $5? I would argue that the best customers probably aren't going to do that. So you'll get the deal seekers, which are probably not the customers that you want. Then the third aspect of it is that there is an incentive for businesses to cheat on this. If I were running a small business and somebody comes to me with a Groupon now that they haven't purchased, I would just say, okay, I'll give you the deal right now. Don't worry about it. Don't push the buy button, because then I won't have to give a cut to Groupon. I'll just give you the deal right off the bat, and I would encourage you every time you come back, just show me the screen and I'll give you the deal, and I can make a little bit more money off that transaction than if I cut Groupon in on the deal. There's a whole wide range of other Groupon now problems, and I haven't written up those problems yet, but that's something that's been on my to-do list. VentureBeat had a piece yesterday that covered some of the problems. The biggest problem right now with Groupon now is that they just don't have scale. They just don't have volume. Yipit numbers, the annualized run rate on Groupon now is something like $2 or $3 million. It's not even a drop in the bucket for the volume of, for the size of company that Groupon is right now and for the size of valuation that they're looking for right now. Do I think the Living Social IPO will be put on a back burner because of Groupon's issues, or will they benefit by learning from Groupon? It seems like they've already benefited. It seems like, according to, I believe it was Bloomberg, they are trying to postpone the IPO and They haven't even done a filing yet. They're trying to seek money on the private markets. It'll be interesting to see how Groupon does in the first weeks out of the gate. Clearly, if Groupon tanks, that's going to be a bad sign for Living Social. If it pops or if it holds reasonably steady, that's not necessarily a great sign, but it's not a bad sign. As I said, Groupon is seeking a $10 billion valuation. There was some independent analysis by Morningstar, which is a investment research firm out of Chicago. They primarily advise institutional investors. They basically came out and told their clients, we think you shouldn't invest in Groupon. We think that you risk long-term capital impairment if you invest in Groupon. They put a valuation currently on Groupon of $5 billion. They have a number of risks, including payment terms, that would put that risk even higher and lower the valuation that they would apply to Groupon. Okay, do I believe in Yipit? Do I believe their numbers? Generally, I believe their numbers. Groupon recently announced that they're going to fudge their public numbers that they show on their website because they're concerned about the amount of competitive intelligence that consumers are getting, or that consumers and analysts and competitors are getting. So they're going to artificially deflate the numbers that they show by anywhere between 0.5 and 19.5%. That will serve to lower the numbers that Yipit reports. But the important thing about the Yipit numbers is that they don't show revenues because they don't know that. They only show gross billings. So if Groupon's business declines in terms of the percent of revenue that they get to keep from each deal, then you're not going to see that in the Yipit numbers. It's just what goes through them, or the total value of the Groupon that Yipit is able to track and now track to a lesser degree. So it's not necessarily a good sign, good insight into the futures of the company because they don't have access to the revenue share data. If you look at Q2 of this year, Groupon on average was keeping 42% of the revenue or 42% of the gross billings that were generated. In Q3, Groupon was keeping on average 37%, and long term, I expect that number to be down at 15 to 20% or lower. So that's going to very severely impact Groupon if that happens. Okay, I cannot for the life of me understand how Groupon can burn through merchants' money the way they do. Why aren't more people talking about that? I'm not sure I understand that question. Groupon, their primary expense has been customer acquisition. They've been spending a lot of money getting new customers in the door and then selling them these deals. Right now, based on my analysis, the lifetime value of customers is below the price that they had been paying to acquire those customers. Potentially that will change over time. I don't believe that to be the case. What do I think of group commerce positioning white labels for publishers like Hearst and more? Every time a new local opportunity comes up, the local newspapers, eventually get on it, probably a couple of years too late. They're always talked about as, people who could potentially compete in this market. Let me tell you, I worked in the online newspaper space for about 4 years. I launched one of the first online newspapers. One of the biggest mistakes I made in my career was thinking that newspapers would ever be innovative and continue to support innovation. I don't think they're going to do it. I don't think that every company that I've talked to who has partnered with newspapers has regretted it because they just don't move very fast. And in this space in particular, people like to say that newspapers have established relationships with merchants that they could leverage. Unfortunately, that's just wishful thinking. Many of the newspapers who have tried daily deals, they just don't have relationships with the small local merchants. Those small local merchants could never afford to advertise in the newspaper, so they don't have those relationships. They have relationships with car dealers and local department stores and other companies like that that have been advertising, but they don't have relationships with the restaurants and the coffee shops and the bars and the dry cleaners and all that because they can never afford it. So, maybe for the weekly newspapers who were more targeting those markets, they would have the relationships that they could leverage. There's a company, I'm blanking on the name right now. There's a company out of Portland that has been trying to do partnerships with suburban weeklies and urban weeklies like SF Guardian that do have those relationships. They're trying a Groupon Now model on a subscription basis as opposed to a per transaction basis. I think they've been reasonably successful. Whether they can maintain a big business out of that, it's a big question mark. Okay, I think I've gotten through a lot of the questions. Again, going back to where the money from merchants go, a lot of it has been spent. As I said, they've got payment terms where in the United States and Canada, they pay merchants within 60 days. By the time that 60th day has come around, they've typically already spent the money. They need more deals to pay off the deals from previous merchants. They have a negative working capital model, which in many cases is a good thing. In Groupon's particular case, I don't think it's a good thing because they're dependent on so many other things. Basically, if the company stops growing, there's a real risk that the company as a whole will cease to exist. And again, in the VentureBeat article I wrote yesterday, I talked about some of the impacts of that. One of the big aspects of it is the credit card companies really stand to lose a lot of money on this that I'm not fully sure that they understand. Companies like Chase Payment Tech and American Express combined could lose hundreds of millions of dollars in that they are on the hook for any chargebacks that happen if Groupons aren't honored. Do I believe Google management is happy Groupon passed on their offer? Somebody during the Web 2.0 conference last week tweeted when Ballmer said it was a big relief that they didn't buy Yahoo a few years ago. I wouldn't be surprised if Google management is feeling the same way about Groupon at this point. Frankly, I'm not fully convinced that Groupon is the one that walked away from that deal. That's what's been talked about in the press, but there's no conclusive evidence of how that actually happened. I wouldn't be surprised if Google was the one that, once they got a closer look at the numbers, said, no, we're not interested in this. I think that does it for questions, and we're over time anyway, so I'm going to sign off. Aggregators positioning DealMap and Yipit. Okay. I think the aggregators, they've never been meaningful. They just don't generate a lot of traffic, don't generate a lot of revenue. And at some point, if this is a stable business that lasts for a long time, Groupon can always cut out the aggregators. Any of the deal companies can cut out the aggregators. We saw this happen with SEO, where in the early days of search marketing, Amazon would let you sell their products through search and essentially arbitrage search placement, and you'd get money from that. And Amazon eventually said, no, if you just are arbitraging search, we're going to stop paying you. You have to provide real content and a real site that is showing that you create some value for us, that we're not just giving you money on an arbitrage play. And I think that's, if the space is sustainable, that will be what happens here. Okay, and with that, I don't see any more questions, so I'm going to sign off. My favorite ice cream. I'm trying to stay away from the ice creams, but when I'm in Italy, San Crispino's gelato is hard to beat. Thank you all for coming. Hopefully there will be a recording of this that you can refer back to. Follow me on Twitter, Rakesh Lobster. I know that's a hard one to just Google, but Rakesh Lobster. Follow me on Twitter. Check out my blog. You'll see me on Quora. In the next couple of weeks, you'll probably see me on Bloomberg and CNBC. So look forward to hearing more from you, and look forward to seeing how this plays out. Thanks a lot, everybody.